Hey everybody, it's Larry Berman here. Markets continue to be very difficult. The world continues to be very difficult. Listening to some geopolitical strategists this week, very mixed opinions on the probability of the war in Israel heating up and broadening out. I still think the risks are higher than most. Um, there's no doubt in my mind there's going to be a cleansing of Hamas in Gaza. One geopolitical strategist I listened to this week, Zion, hope I pronounced his name right, kind of said that Iran, even though they've used Hamas as the catalyst to upset Israel in the Middle East, would throw Hamas under the bus because they are Sunni Muslims, where the clerical leaders in Iran are Shia Muslims and they hate each other, and they're just using them, and they don't care for their lives any more than they care for the lives of Israelis. And because of that, Iran's not going to get involved in the war. And so who knows? Let's hope it doesn't do that, but I fear it might. This time of year, October is eerie from a market risk volatility perspective, as all will know. Not surprising to see the S&P 500 go out at the multi-month lows. Let's have a look in the chart room. Market breadth on Friday, no matter how you slice it, was pretty weak across the board. Even before the later selling in the U.S., Europe went out with the vast majority of stocks on the downtick. But the tape wasn't, sell everything capitulation. There were a lot of names that were still up on the day. So by no means would you say this is a sell all, but going out right at the near the 200-day, the Fibonacci, like that's going to probably be tested thoroughly early next week. And if it breaks, then that really opens the floodgate to a lot of CTA type trend following type technical selling. So when you look at the trend, you can see clearly today a break of that trend that's been in place for the better part of a year now. We tested that a couple weeks ago. We bounced again a lower high, and now it's rolled over. As earnings period has started here, again, our forward-based earnings in the last couple weeks has started to come down, not in a big way. But again, if we are going into peak growth and harder landing scenario, which I believe we are, then this number is coming down towards 200, I would think. And at an 18 multiple, which is still expensive, gives you 36. So I think those are the numbers that, in the context of whatever this harder landing plays out, are minimum objectives here for the market. So we could see it by the end of the year that the entire gains for the S&P 500 this year are wiped out. And while we look silly for months telling you to all be cautious and not to chase the rally, and that this wasn't the beginning of the next bull market, now it's starting to show its stripes, its real stripes there. So again, big catalyst on the interest rate side. One of the trades we did in our bond fund, we haven't had a bond fund for a number of years. Interest rates are starting to get interesting, folks. So we launched a bond fund a few months back to take advantage of moves in duration. We had been holding most of that bond fund until recent weeks. And when I say recent weeks, I mean recent weeks, where we're starting to see yields in the 5-year. So this is a current 5-year coupon bond. And you can see trading at a slight premium to par. It's at an equivalent level to where you could lock in 5-year money at around 5%. compared to if the Fed does start to cut at some point next year, whenever that might be, then you're going to benefit from a move in duration, and you're ultimately going to get that 5%. So it's starting to get to the point where you want to lock in those yields. Now, you're not going to lock in on a bond fund because that has duration and reinvestment risk. So you want to be in a bond specific. And this is where sometimes ETFs are not going to do the job. Now, in the US, they have these targeted. So there's an ETF, IEF, I think is the ticker. Let me just double check on that. That gets you into the 7 to 10. There's one that gets you a little shorter than that. I can't remember the ticker on it. So my bad for that, but you get the idea. But even that, you've got reinvestment risk. So buying a bond, holding it to maturity, less volatility, but you can lock in those yields. And for those of you who can do that, I would strongly encourage you to do that. So, a lot of products we mentioned last week coming out with volatility enhancements. What we're looking at here Friday at the close is a 1-week option on TLT. At the money, 83.24 is the close. And if you look at an 83.50 call, you're getting for the week 93 cents. So you're taking in a little more than 1% for exposure for a week. That's how volatile the bond market is and the risk around duration. Now, part of that is because eventually, if a war does escalate, we will get a flight to quality and flight to safety into bonds. But there's also a lot of bond supply coming next week as well. So, tough for the market to digest all the supply. That's not going to change anytime soon. So in order for us to get a real risk on duration rally here, that flight to safety needs to happen. And I think it might, but when we look at the price action in recent weeks since this war broke out in Israel, and you look at the flight to safety things, gold. So we talked a few weeks ago about gold as being one of the places you want to be, and that's moved, which we would have expected. I would not look for these to break out unless a full-on war escalates, and then you're going to see a big move in gold here. I wouldn't be owning Bitcoin if that happened. That is not a good hedge for volatility in asset markets like gold would be traditionally. So don't make that mistake. Bond yields. Okay, so the 30-year again peaked out over 5%. This is the sweet spot. You can lock in that 5 for 30 years. Not that you would want to necessarily do that, but you can look at a strip bond here. You can buy a 30-year strip for about $35 and lock in that 5% plus as a capital gain for 30 years if you're looking for safe long-term money. So there's lots of ways to get into positions now that interest rates are getting more and more interesting. So where does this thing go on a flight to safety? Well, the initial bid off the thing was about 25 basis points before it ran into resistance. And I think we could get back to maybe 4.5 in a full-on risk-off global catastrophe, maybe a bit more. But again, with all that bond supply out there, I wouldn't look for too much more than that at this point. Crickets from the US dollar. So this speaks to the underlying problem with the US system and the budget and the lack of leadership in Congress and on and on and on and on, why you're not seeing a flight to safety into the US dollar, where historically that would be just a no-brainer trade. I'm not saying Europe's better off. I'm not saying Canada's better off. Certainly Paylesses and EM aren't better off. But it speaks volumes, and hence why gold is running here. So that's really kind of interesting to look at. And then finally, crude oil. So obviously, if there's an escalation in the Middle East, crude looks good. U.S. did announce this week they were going to start buying into the Strategic Petroleum Reserve if they can buy it at a certain price. So that's going to put a floor under the oil market for now. And I would expect if we do get an escalation where Iran gets involved and missiles start flying all over the Middle East, that we will see a spike above 100, temporary spike, sell into it. That's all I have this week. Let's pray for peace here and hope for the best and just continue to be very cautious on your portfolios.